Good day, my name is Bianca Haywood and I will be taking you through Pick n Pay's results presentation. Please do note that I will not be answering questions throughout the session. However, you're more than welcome to type your questions into the chat box and I will be getting back to you via email correspondence. Let's take a look at what we will be covering today. I'm going to start off with the nature of business, followed by the recommendation, the financial review, divisional overview, company guidance, and conclude with the portfolio guidance. Now moving on to the nature of business. Pick n Pay is a grocery, a clothing, and general merchandise retailer selling a wide range of products at a very competitive price under the Pick n Pay and Boxer brands. Pick n Pay owns a 49% stake in Zimbabwean supermarket group TM Supermarkets. Now moving on to the recommendation. On an absolute basis, we feel that the share is fully valued, but seems fairly valued on a relative basis. The group should be able to achieve above average earnings growth over the medium term as the operating margins recover from its current low base, making a 24 PE more palatable. A considerable portion of the group's transformation initiatives have been implemented, with the benefits of these transformation initiatives expected to become more evident in the year ahead. Although the trading conditions is expected to remain challenging in the short term, the group will start to reap the benefits of its strategic initiatives through improved customer shopping experience, better operating efficiencies, and through improved supply chain. The group should also start to realize the benefits from the new space added, which should result in meaningful cost reductions and improved operational efficiencies. Now moving on to the Voluntary Servants program. The group initiated a voluntary servants program in April 2017, which is a key part of modernizing the business and reducing the costs. The program is now completed, removing around 10% of the roles and functions across the group. The full cost of the voluntary servants program was expensed during the first half of the year and will be recovered towards the end of the year. However, the financial benefits is only expected to be realized from 2019 onwards. Now moving over to the financial review. It is important to note that the results are presented on a normalized basis to exclude non-recurring items relating to the Voluntary Servants program. Turnover increased by 5.1% or 1.8% on a like-for-like basis, reflecting the challenging trading environment and some of the disruptions that the group experienced during the first half of the year. Internal food inflation was contained to 3.9%, well below the official CPI figure of 6.9%, reflecting the group's investment into lower prices to customers. The total number of transactions grew by 2.2%, with the average transaction volumes increasing by 3.1%. The group added 63 new stores, 40 company-owned and 23 franchise stores, and refurbished 34 stores during the first half of the year, adding 1.5% to trading space. At the end of August 2017, the group had a total of 1,613 stores, of which 183 was next-generation stores. Gross profit rose 4.5% to 7 billion, resulting in a slightly lower gross margin of 17.8%, down 10 basis points. Other trading income rose 24% or 8% on a comparable basis, driven by a 14% increase in franchise income, reflecting the 46 new franchise stores added over the year. Adjusted EBITDA rose 11% to 1.2 billion, supported by well-contained costs. Trading expenses rose 5% or 1.6% on a like-for-like basis, reflecting the strong management of operating costs. Occupancy costs rose 15%, driven by the addition of 89 net new company-owned stores, while on a like-for-like basis, operating costs rose 10.2%, reflecting rental escalations, higher regulation and security costs. The trading margin rose 10 basis points to 1.6%. Net interest cost more than doubled to 70.6 million, reflecting the lower cash balances due to the investment in new store openings and the centralization program, in addition to the cash outflows relating to employee compensation payments as part of the Voluntary Servants program. Normalized diluted headline earnings per share rose 13% to 90.36 cents per share, while an interim dividend of 33.4 cents per share was declared, 12% higher than in the prior period. Cash generation was strong for the period, while capital expenditure amounted to 778 million during the first half of the year, with 80% of the capital expenditure aimed at improving customer shopping experience. Now moving over to the divisional review. South African operations contributed 95% to group revenue and 79% to profit before tax. Turnover increased by 5% to 37.4 billion, while profit before tax, excluding the net impact of the Voluntary Servants program, rose 13% to 478 million, translating into a slightly higher profit before tax margin of 1.3%, up from the 1.2% in the previous period. The group increased the total volumes of goods centralized to 65%, up from the 60% in the previous period. Centralization in Gauteng and Western Cape region increased by 69% and 76% respectively. The group is due to open a new distribution centre in KZN before year end. The group continued to expand its private label and convenience range. The group launched 400 new private label products during the first half of the year, of which 163 were new and 237 were redesigned or improved products. The group will launch a new convenience meal for kids during the second half of the year, and during the first half of the year, 1.6 billion personalized discounts was offered, with more than 45 million vouchers issued each week. The group redesigned and launched its new mobile website. The online service offers customers the opportunity to collect online orders alternatively to having it delivered. The traffic on the Pick n Pay online website increased by 32% in the half year, while online sales in Western Cape increased by 25% year on year. The group also plans on opening a second dedicated warehouse in Gauteng to further service online customers in the region. The group brought its delivery service in-house and improved its service delivery through 1-hour slots to expand capacity. The group also launched its Pick n Pay store account, which gives the qualifying customers access to credit that offers up to 55 days interest-free, provided that the customer's balance is fully paid off monthly. The store account is designed to offer the most affordable form of credit in the market, with no joining, no transaction, and no hidden fees. The store account can be accessed through existing Smart Shopper card. The group's money transfer product, in partnership with Time Digital, had 200,000 customers registered either with Pick n Pay or Boxer by the end of the period. In line with the group's plans to launch a digital bank, Time Digital was recently awarded a banking license by the South African Reserve Bank, a first in 18 years. The group will be working closely with Time Digital to provide greater access to financial services for its customers. Boxer converted a further 21 stores to next-generation formats, with 70% of all Boxer formats in KwaZulu-Natal already converted to next-generation formats. Boxer opened 13 new stores during the first half of the year, and in the second half of the year, the group will add a new distribution centre in East London to service Eastern Cape stores. Now moving on to the rest of Africa. The rest of Africa contributed 5% to group revenue and 14% to profit before tax. Revenue rose by 15% or 2% on a like-for-like basis to 1.9 billion, while profit before tax increased by 15% to 87 million, supported by improved franchise performance. The profit before tax margin was maintained at 4.8%. The trading environment in Zambia remained tough. The group added 1 new store in Namibia and 3 in Swaziland, while 2 underperforming stores in Namibia was closed, bringing the total number of stores outside of South Africa to 142. Associates contributed 7% to profit before tax. The group's share of TM Supermarkets earnings grew by 43% to 40 million. Now moving on to the company guidance. Looking ahead, management expects the economic outlook to remain challenging and the retail consumers to come under increased financial pressure. However, management will continue to focus on lower prices, better promotions, more personalized discounts, an improved product range, and ongoing investment into fresh and private label. In March, the group announced a 500 million price investment and dropped the prices of 1,300 grocery items. A further 500 more prices will be reduced during October, specifically in the fresh offering. New space and next-generation refurbishment is expected to continue to yield results, while the new operating model will be rolled out across even more stores. Two next-generation formats will be launched during the second half of the year. The group will also open 50 new stores, including 10 Pick n Pay and 7 Boxes stores. Management indicated that they will continue to work closely with the suppliers to improve the ranges and bring more innovation to customers. The group will also continue to expand its financial service offering. The continued centralization and the opening of the new distribution centre in KZN and the second Gauteng dedicated online warehouse should improve operational efficiencies even further. The group remains dedicated to its long-term prospects in the rest of Africa, and the group has planned capex of 1.6 billion for the 2018 financial year. Now moving over to the portfolio guidance. Pick n Pay has a weighting of 0.4% in the cap sweeps. We are neutral on the stock and would recommend zero exposure at this stage. Please take note of the following disclaimer. This concludes my webinar. Should you wish to place a trade, please contact our trading desk. Should you want to ask questions, please type them into the chat box. Thank you and enjoy the rest of your day.